Let's bring in CNBC contributor Greg Branch of Veritas Financial Group for his view. And Greg, bring us up to date here a little bit. I know you've been, pretty consistent in kind of higher rates for longer. You thought maybe the Fed was going to have to get well above what market expectations were, towards 6% perhaps. Where does yesterday's events and comments by Powell leave you with that?
So the events have actually done and will continue to do some of the Fed's work for it. And that's the reason that they can now forecast only another 25 bips. And so I obviously have to reconsider what my target for terminal rate was at 6% because the Fed's not doing it alone anymore. What we know from what happened in the financial system is that credit will be harder. That will slow the economic growth. What we know is that with slowed economic growth, unemployment will probably rise. And so with all of that, underwriting standards going higher, more caution, both from employers and from banks, again, that's going to do some of the Fed's work for it. I think when we look out, there's still things that I'm concerned about, even though I'm not concerned about the market not discounting a terminal rate that's factual for a long time, I think, through the summer and winter. So I'm not going to be a hypocrite here because I argued that people were not listening to the Fed. And so I'm going to listen to the Fed and I'm going to believe them, which does not necessarily rule out that we'll see some reflation in that back end. We'll see. But now I'm concerned about things that the market is not discounting. And so when we look at consensus estimates for the fourth quarter of this year, they're still at 10% earnings growth. I don't know what the pathway is to get from the negative 5% we saw in the fourth quarter that just passed to a 10% earnings growth in the fourth quarter of this year. And I'm having a hard time trying to justify that. I think what the market is probably missing is the deceleration in earnings and maybe some margin contraction in terms of profits. And so I think that there's still things that the market's not discounting that prevent me from going really bullish here at this time.
Well, I mean, I understand that, there certainly could well be downside to earnings estimates in the latter part of this year. Although if talking about the year-over-year percent change, I mean, that's just maybe the fourth quarter is going up against easier comparisons than the first quarter was. I just wonder whether, as that gets into the consensus numbers, right? Where were we on 12-month forward earnings 8 months ago, like at 240, 250, and now we're down in the 220 area, and the market is just kind of chopped sideways. Do you see any particular areas at risk in that process where you think the economy is going to, kind of drag earnings estimates lower?
I think we'll see a reversal of what we've seen the last few months, what we've seen in 2023 so far. As my colleagues noted, the things that worked in 2022 largely traded down the first couple of months of this year, as I think that the market was at least hoping that the Fed would stop or pivot and that we'd have just a general tide that lifted all boats in the wake of the Fed being done or pivoting or what have you. I think what will happen going forward is that we'll see that reverse. And what worked in 2022 will work again. When we talk about defensive positioning, the problem we have is that now you can be defensive by going into short-term fixed income where you're being paid to wait. And so being paid a 3 or 4% yield with no market risk, that's a defensive position. So we're not obligated to find that exposure in sectors in the stock market. But I do think that that's where the equity flows will go, to those sectors that will deliver for us consistent earnings growth that we can count on no matter what the macro environment. And as we've said, that's utilities, that's healthcare, that's some select areas of technology, and maybe even some financials as we get down close to 1x price to book.